know everybody wants to provide the highest quality, standard make ready that they can because your reputation is attached to it. Listen, nobody wins if you don't have money to pay. The residents don't even win if you don't have money to pay the bills. It's tough, but when you were spending 2,200, now you're spending 2,500 on a vinyl flooring replacement. Hey man, we might have to look at quality that we can afford.
What's going on, everybody? Welcome back to another great episode here on the Multifamily Wealth Podcast. In this week's episode, I am interviewing Stacey Hampton, who I've actually had on the show before. I believe her first episode was released in April of this year, April 2025. And I couldn't be more excited to have her back on the podcast. The first episode that we did crazy numbers. A lot of people listened to it. Tons of people enjoyed it. And I think it's because it was so incredibly tactical. And to give everybody a refresh on who Stacey is, Stacey runs Asset NOI Consulting. She's been in real estate for 20 plus years, and she is a wealth of information as it relates to asset managing multifamily properties and really just getting the most out of your multifamily assets from an operational standpoint, driving NOI and everything else that really results in driving NOI, maximizing renewals, minimizing vacancy, increasing tenant satisfaction, all that stuff. She is a great conversation because she speaks really tactically about what I think a lot of multifamily investors are trying to improve in their business right now, which is I need to operate better. I need to operate more effectively. I need to maintain my NOI and increase my NOI as the market continues to be a challenging environment to operate in, especially in a lot of the pockets of the country that are being just drilled with new supply. So I wanted to have her back on the podcast because it's still a really important topic to be discussing, and because, the first episode did so well. And because I think that she brings a really tactical voice to the podcast that a lot of the listeners find value in. So in this episode, we just jump right back into a lot of similar topics. We dive into how to nail your end of year budgeting with your property managers, how to turn budgets into actionable plans with your PMs and your PM companies. We talk about a lot of the tools she's seeing, both from an AI automation standpoint, AI resources space, software standpoint, really everything that's helping asset managers stay ahead of the curve from an AI standpoint. We talk a lot about how to approach leasing from a fundamental standpoint. And I think this is one of my favorite, kind of snippets from really a lot of the recent podcasts that we put out over the last few months is speaking with Stacey about how she wants to see her leases roll over the course of a calendar year. I think that there's probably some diversity in thought around the best approach there, especially when you consider seasonalities of different markets. But what she describes is really, really interesting in terms of the logical reasoning as to why you want leases expiring at different times. And we get into that at a really tactical level. So for all the multifamily operators out there who want to learn how to better operate their multifamily assets, this is going to be a killer episode for you. And you got to listen to the entirety of this one. I'm sure you're going to learn something in this episode, and just my request as somebody who hopes you learn something and who really, I'm pretty sure you're going to learn something. I'd be shocked if you didn't in this one. My ask for you in return is that you leave the podcast a rating and review so we can continue growing the show and getting it in the feeds of more and more folks who want to learn more about multifamily investing. But as I always say each week, hope you enjoy the show. I'll catch you guys on the next episode and enjoy my conversation with Stacey Hampton. I am joined again for the second time on the podcast by Stacey Hampton of Asset NOI Consulting. I believe it's been right around 6-7 months, April of 25, since you were on the show first, I should say, since we released the first episodes. Very well received. Before we hit record here, literally 2 minutes ago, for the audience, just in terms of understanding kind of the, what happens when folks can go on podcasts and kind of the version of a world that gets pretty small, especially in multifamily real estate. You've had some folks reach out to you as a result of being on the podcast, which I love to hear. And I think that's because the first episode was fantastic. One of my favorite episodes that we've released this year, specifically because we got to nerd out on some operations and some asset management stuff. So for the listeners out there, I'll include the link to the first one in the show notes. Obviously, don't click away and listen to this one first. But Stacey, I appreciate you taking the time to come back on the podcast and chat again. And if you don't mind, giving a refresh to everybody who's listening as it relates to your background, how you got into real estate and what you're working on today, that'd be great.
Yeah, yeah. Well, first, let me thank you for having me back. I enjoyed it the first time a lot. As I mentioned, I got a lot of people over the course of this year that have reached out to me that heard me on the podcast. So that was pretty terrific. As a matter of fact, last week I was in a meeting and somebody meeting an asset manager, sharp guy for the first time, and he recognized me and said, "Hey, I heard you on the Multifamily Wealth podcast." And it's been months ago. So that was like a first time for me, meeting someone for the first time in Zoom meeting and being
Love it.
recognized. So that's pretty cool.
You get the credit for that, for recording a great show. I get like 25% of the credit. I'll take 25% of it, but 75%
He
goes to
was
you
a
for sure.
fan. We
Yeah,
nerded out on several episodes. But in
I
any
love it.
case, I've been in multifamily for 25 years. I started my career in hospitality. So think, hotels, resorts, restaurants, and I got bit by the multifamily bug. Thought it was going to be easier. In some ways it is, some ways it's not, but at least you don't have to replace your residence every night. So
Hmm.
I appreciated that. And I got in at entry agent role and worked my way up in various different roles. I'm kind of in the weeds kind of gal, and I think that definitely opened a lot of doors for me. And ultimately, a couple of years ago, I started my multifamily consulting firm, and now we've grown to four people, which is great, and we're extremely busy. So we help property management companies and asset management teams. Sometimes I like to say we're in the purgatory between them, or better said, a conduit to help them increase the value and the revenue of their properties. And I wouldn't be doing anything else.
Love it. Yeah, I think it's an interesting space to be sitting because I think as a result of, and we probably talked about this, in the first episode a little bit, but as a result of the influx of new investors and, or maybe investors coming from different asset classes, in addition to just new investors to real estate and multifamily real estate specifically between 2018, 2023, as the market was really hot there. I think there were a lot of folks who maybe didn't have clear asset management experience or property management experience that found themselves sitting in the asset management role as sponsors, GPs, or investors buying these deals. And even if they had the best intentions, I think oftentimes there's a disconnect between what is asset management and what is property management as it relates to like what is the true role and responsibility of an asset manager versus a PM. And I think a lot of newer investors or investors from different asset classes, maybe don't understand where that clear line is, right? And you sitting between the two, I think is a really interesting place to be sitting within the business. Before we dive into maybe the real tactical component of our conversation today, I always think it's helpful to discuss really quickly, in your words or in your minds, where do you find that line to be between asset management and property management? How do you think about those two roles, kind of broadly speaking? And, I'll contextualize it for the listeners as well. Like you're predominantly working with the asset managers of, call it, large multifamily complexes managed by on-site staff, et cetera. I just say that as a frame of which to kind of view your answer to or through for the listener. But in your mind, what is the difference between those two roles and how do they, interact with each other?
Yeah, yeah. So, I think from an asset management perspective, it's a high level strategic role, but property management is kind of the tactical role, right? That's the one that's actually getting in there and executing the strategy. And you know, I think from, at least in today, there's a real need for asset management to have tactical knowledge, to be a strong advocate for their asset. And so you were talking about definitely a lot, a good portion of our clients are maybe newer, or, got into the business. But one of the big challenges today is that so much has changed about multifamily tactically between software, the market, buyers' behaviors, or as known for us, renters' behaviors, that even the most seasoned owners and asset managers need and property managers need support in navigating all these changes and opportunities to improve. I mean, it's a totally different business in some respects, right? Shop renters buying patterns alone are wild. I mean, they're showing up on the property to verify what they've seen online, but they've usually got their mind made up. And so that alone is just significant change to the industry.
Hmm. Quick follow-up. How do you recommend that hypothetically, let's say you're this listener that I'm talking about is a sponsor of a few big deals, 100+ unit deals. They've got a third-party PM company that manages them, and they're doing what they should do, right? Quote unquote should do. I'm leaving it pretty vague here. They're on a call on a weekly basis. They're getting some weekly KPIs, occupancy, delinquency, talking about lease renewals, but there's still a very clear relationship of they've got a third party property management company. They're asset managing the PM company. A lot's changing in the marketplace right now, as you've described. It's a tougher market to operate in right now than it has been over the last few years. Any tips for that individual to maybe develop a little bit more of a, sense of what's going on at the property level, or to start thinking more like a property manager, to get a little bit more intimately involved with what's going on, to kind of help them think more like a PM, or understand what's actually happening at the property level above and beyond what their PM is telling them?
Yeah, yeah. I mean, the first thing that came to mind is, you know, because I used it as an example, is shopping your property. And a lot of asset managers and owners do that, but most of the time they're just looking for, did they get a call back? Did they get a text? Did they get an email? Did it have, and I think that's really great, but additionally, the objective beyond getting I quit using the word follow up and I've started to use the word conversion. The objective is conversion, right? And so you have to obviously get a follow-up to convert to get a conversion, but looking at the quality of the follow-up and will it convert? It's not just enough to say, thanks, Axel, for your interest in none such apartments. If you'd like to schedule a tour, click here.
Hmm.
Our digital people sometimes like to complain about, and to include myself, about kind of the conversion process of multifamily, but your digital leasing agent, as I mentioned before, is the very first person that he speaks to, unless they just happen to be in your neighborhood and pop on in.
Hmm.
So that would be a tip. Secondly, is, you know, most asset management is focused on KPIs and not the metrics that make the KPIs.
Hmm.
So if you've got occupancy, yeah, everybody follows move-ins, move-outs, renewals, but there's usually a few missing metrics in there that you probably need to follow, which is skips and evictions, maybe even turnover, average leads per week. There's the metrics that roll up to the KPIs that really are helpful in understanding the cadence of when things are going right and when they're going wrong.
Yeah. I think it's a good tip to try to head a little bit farther upstream from a data standpoint. As you
Agreed.
described, right? Renewal rates, days vacant, number of vacant units, vacancy at the property level. A lot of that stuff is downstream from more symptomatic issues upstream. What's your conversion rate in your leasing funnel? I mean, even above that, like how many leads are you fundamentally getting? Kind of working back up to the top of the funnel, and the bottom of the funnel is new leases spit out, and therefore your vacancy rate is probably going to be helpful as you analyze a lot of this. And I think you're right, like secret shopping vacancies, and role playing as a prospective resident and trying to work through that process a few times a year as you're looking at vacant units at a property is probably going to tell you a whole lot about what's going on at the property level and then at the PM level. So I think those are great tips. Let's talk about what happens at the end of a year. This episode is going to go live before 26, sometime in December. I don't have the date in front of me, but it's going to go live as a lot of operators here are. Maybe some of them have wrapped up their budgets, but maybe some of the smaller operators here are going to work through putting together budgets for 26 and start chatting with their PMs and talk about, things to focuses as they end the year and what they want to focus on heading into next year.
Sure.
Let's just start pretty broad here. So you're role playing here as the asset manager or sponsor of a large multifamily asset, working with a third party property management company, or I guess, maybe you have an in-house management company. It's the same process. But what are you thinking about as you arrive at the end of the year, conceptually speaking? And what do as you put together a budget, how do you think about that process? Is there anything else you focus on as you get towards the end of the year from an operational standpoint? And I guess the easier question is, what does the end of the year look like for you as you're operating an asset?
Yeah. Yeah. Well, I mean, first I would say I want to land Q1. I've had a saying forever. If you don't land Q1, you've lost the year for the
Mm,
most part. If you start behind, you're going to stay behind. And the reality is, and this doesn't matter what time of year it is, once a property is under budget on their NOI, they often throw the whole budget out the window. What I mean by that is they don't, rarely do I see any groups trying to figure out how are we going to make this up. Okay, so we're, you know, 2 or 3% behind budget. Where are we going to make this up? That almost never happens. But it's pretty demoralizing when you start the year and that first set of financials in January, which will come out in February, shows you're already behind budget. Ouch.
mm.
That really hurts. It hurts the property manager's morale, and I think it probably impacts the asset managers and the owners as well.
That's interesting. Yeah. So it's both. Well, I mean, there's obviously a data argument around that, right? It's like if you start behind from an actual tactical NOI number, you got to work hard to speed or catch up to the budgeted or the NOI objectives that you set at the end of the year before you head into the new year. But I think it's an interesting point, like morale too. You're kind of losing proof of concept with your PM company, right? If you whiff on the first couple of months in January and February and you have a rough Q1, there's probably less of a focus on meeting the budgeted numbers because they were off to begin with. And there's almost like a conceptual distancing from the original budget is what you're saying there early in the year.
Yes, but adversely, this is how when I was managing teams and communities directly and with my clients today, when you land January, February, Q1 with a surplus, there is nothing better because you've already started the year with money in the bank. So to answer your question, usually by this time of year, I have already started because budgeting in for third-party management companies and big groups, budgeting actually starts in August or September,
Hmm.
right? About this time, they're getting to the investors or to the owners for approval, asset managers for approval. Way back in August and September, I'm looking at my fee structures, I'm looking at the services, I'm negotiating contracts, and I'm already implementing. It's kind of a twofold part. I'm going to tell some secrets here.
Oh,
So
here we go.
I'm ready to spill the beans. I told you that. So let's just say it's September, right? Decision that you're going to increase the trash fee $5. If you implement that immediately, we all know that leases expire on a 12, 13, 14-month basis. If you implement that immediately, say September, all renewals, all new move-ins starting in September, you're at a $5 additional trash fee. I'm just using that because it's simple math. But so you're already making the decisions and getting the positive impact from those decisions before to also make sure you land the year,
Right.
right? So I usually, if I had any properties off, and usually by not much, I can make it up because I didn't budget for that $5 increase. I didn't budget for this or maybe renegotiated rates, right? So I get a little bit of the benefit there. And then obviously you're going to ramp it up over the course of the next year. But when you make those kind of decisions at the end of the year and you implement them before the new year starts, you're reaping the benefits on both ends, right? You might even be making up some deficits that you've been running with throughout the year. So I think that's extremely important. This time of year, obviously, I'm very, very focused on high occupancy, higher than normal, because listen, especially in workforce housing, you already know you're going to have some skips and evictions. They're going to fall in January, they're going to fall in February, depending on the courts, right? So occupancy needs to be at its peak when you end that year. And how to get there varies. There's several different tactics, obviously being competitive on rents. But if you're a real planner like me, you've already stacked up your renewals in December or, whatever. A lot of people don't like doing higher expirations in December and November. I disagree. People are much less likely to move in November, December because of available cash and holidays. And, yeah. It's
That's
like
interesting.
on
It
one
makes
side, it's
sense.
harder to
Yeah.
rent, but on the other side, typically you see, north of 60 retention rate. So I guess it depends on what strategy you want to use. But nonetheless, you also get a little bit better. This sounds real grinchy, but rental increases during that time.
I,
So
well, I want to dive into this because I think this is really interesting, and I think we focus in our business, and you're familiar, and I'll remind all the listeners as well. Like we're based in New England, like we buy in New Hampshire, we're in the Northeast, right? So it's very seasonal from a four seasons standpoint. We have a much harder time leasing units when they come vacant in the winter, call it December, January, February. Just, I think there's just more, the leasing cycle is far more focused on a May to September, cycle, right? Late spring into kind of early fall and predominantly the summer, right? June, July, August is when a lot of folks are moving. It's easier to move when there's not a bunch of snow on the ground, right? And then you obviously have the other dynamics of you're doing it before school starts and you're, kind of checking some of those boxes. So we really focus on, well, we certainly want as many leases churning in that period of time. But what I find to be interesting is what you're describing, because there is there's conceptually it makes sense, right? You don't want to move in December. Who wants to move in December, right? You're around the holidays. That doesn't make any sense, right? You're going to go and deal with a move, and then you're going to quickly get set up for Christmas and this and that. And in my mind, when you think about on the tenant side, it's like there may be less demand, or I should say on the leasing side, there may be less demand as a result, which is why we don't want units coming up then. But what you're saying is really interesting, which is almost a continuation of that thought, where it's if you have more turning in that period of time, your renewal rate will be higher because there's less alternatives for those particular residents, and they also don't want to move. I don't even really have a question there. I'm over here sitting here thinking about, oh, that's a really interesting way to think about it. You mentioned 60%. Because I almost cut you off at the end there. 60% kind of renewal rate in the winter. Is that like a piece of data that you guys have tracked as it relates to like renewal rate in the winter versus renewal rate call it in the summer, and you have some data behind that, or is that just kind of your gut feel as it relates to what you're seeing when you're advising asset managers and looking at their portfolios?
no, it's specifically renewal rates are higher, 60%. I said north of 60, because I'm 100% sure about that. No
Hmm.
matter what property it is, I rarely see renewal rates fall below 60% in December. But what I do see after looking at hundreds of properties is retention is always the highest in the months of November and December. So whatever it is, whatever your average is, it's always going to be higher in those months. And that is certainly true for workforce housing because like you said, no one's moving in December unless they absolutely have to.
Yeah.
And here's the other thing that's kind of interesting about that I've observed over the years, which is most companies aren't hiring in December. They wait until January to hire. I bet you've heard that, right?
Yep.
So there's also that. There are a few. there are literally less job changes that happen in December, fewer people. Everyone will wait till January. So I think that has an additional impact even on, single career folks that, could otherwise maybe not care so much about Christmas
Yeah,
and moving
just
a tree
a
and
guy
all
living in
that.
a one bedroom or whatever is obviously different than, a family living in a two or three bed. We're gonna get back to budgeting and end of year stuff. But quick sidetrack here because I'm interested in your take on this. So let's say you have a large multifamily asset, and in this fairy tale world, you can just decide, all it's 100% occupied, all the units are leased. Like, what would be your ideal distribution of when those leases expire through a given year? For example, I use the context of in our business, we want a large percentage, right? And I will say we don't necessarily have like a goal around it, but we want as many of those leases expiring between May and September in our market. Although I'm probably going to go and think further about should we try to more evenly distribute throughout the year. But in your world, let's say you just get to assign lease expiration dates across this whole portfolio, or not portfolio, property, excuse me. What would be the ideal distribution in your world from an ideal asset management standpoint?
By the way, I do assign them through
That's
lease
true.
expiration
Yeah.
management. Yeah, I decide how long the leases are and I put caps on the months, and I do that a lot for my clients. But so the question was, how would I distribute?
Mhm.
It varies slightly by asset class and by floor plan type. So, but here's what I'll say as a general rule. Usually for workforce housing, I try to do the least amount of expirations in the first quarter.
Got it.
And that's because of income tax checks. That's because of, frankly, workforce housing due to evictions and skips has a lot more inventory during that time. And then between Q2, now other people say, yeah, but they have income tax checks and they can move. Overall, I found it just not to be advantageous. A lot of those are skippers,
Yeah.
evictions. And then, from there I would distribute the majority of the leases, but I don't want too much exposure in the summer, right? So let's try to put a percentage on it. Let's say I'd want to have, watch me bungle this math, but let's say I wanted to have somewhere between I'd say 5 to 7% in the first quarter of expirations for workforce housing. I'd probably ramp that up to maybe up to 10% in the second quarter and through the summer. And then probably the fourth quarter, I'd like to see somewhere between 15 and 12% expirations during that time. It sounds like a real risk, but it pays off big time because the intention is one, you don't want inventory. You're not wrong what you said.
Hmm.
Agreed. Both things are right. You don't want a bunch of inventory in the fall. And a good way to do that is not have too many leases expiring right before the fall. And then I really want to have the highest occupancy in January and just hold it. So in that sense, fourth quarter, first quarter, you got to land them.
Yeah. I think my summarized takeaway is you're just like at its most bare bones level, and this is probably, this is consistent through every region of the country, I would say, probably it seems, is you want far more leases turning or expiring and having those renewal conversations in November, December, comparatively to January, February, where I think a lot of people, especially in the Northeast, are like, it's all winter. It's a very broad categorization of that period where it's like, December, January, it's the same. Nobody wants to move because it's winter. But you're right, there are some really subtle dynamics of, well, pre-Christmas and New Year versus post-Christmas and New Year are two totally different dynamics as it relates to those are like really pivotal events in the calendar year that make people not want to move versus afterwards where all right, that stuff behind us, we can go move if your lease is turning, July 15th or January 15th or February 1st or whatever it might be. And I think that's a really tactical tip for the listeners is like if you've got a lease coming up for a tenant in I don't know, mid-January, try to get them on an 11-month one that expires them in December versus taking them 12 months back out to January. All right. I sidetracked us. We'll go back to budgeting here and end of year planning. So let's just say we've got our budget. We've had this conversation with our PM company. We started, let's say we backed up. We started this September, August, maybe October. We've put it together. We're we're trying to start to make some steps to implement it, knowing that we kind of have to get ahead 60 days, 90 days of making these changes so that as we head into the new year, a lot of the things that we're trying to do for that next year already started, have started to kind of bear some fruits. How do we actually take that budget, reframe it as a business plan and actually convert that budget into something that's actionable and maybe measurable with our PM company and start communicating it to them through that lens?
Yeah, yeah. And by the way, if you haven't already, I think this is the perfect time to do this, particularly as asset managers and owners probably have their budgets in hand and are reviewing them right now for to be finalized and plugged into the PMS system for January. The first thing I would say is, you know, when you're looking at the budget, it doesn't matter who you are. You're looking at the budget and you're comparing it to last year, right? Typically, there's a column here for, year-end totals. Then there's last year's, so you're comparing them side by side. And you're wanting to know what? I mean, is next year going to be better than this year? Is Santa Claus coming? So
Hmm.
in 2026. And if the answer is yes, and you're an asset manager or owner, the question for me is how? How specifically are you going to increase occupancy from last year? You need the answers. The answers are the action plan. So to be specific, you're looking at, the very first thing, GPR. Most of us are saying, do we think rents are going to go up in 2026? And if so, how much? Right? You need a contextual data point, first of all. How much did they go up last year? I think is a really good question to ask, right? You're vetting this out. Is there any reason for me to think that they're going to continue to go up this year? Or is there absorption? Is there new or go down for that matter? So, okay, so everybody knows that. But then we get to the line items and it's funny because most of the time the budget you get's pretty optimistic. And I could explain why if you wanted to get into it. But you're getting to, let's say, bad debt. Okay, so bad debt's going to go down 10%. Why? What are you doing differently in 2026 that you didn't do in 2025? Is there anything different? Have you implemented something? Have you tightened criteria? Do you have a guarantor service or a deposit replacement? Are you asking for higher deposits? Owners and asset managers need from their PMs specific action plans for the improvements they see. You can't just say, I think I'm going to get a better class of tenant. Or maybe we haven't had, like, there needs to be some data behind the improvement. Going to just overall occupancy. Okay, so why is the occupancy? What do you think is going to make the occupancy in 2026 higher? Well, we're going to have better retention. Okay, well, what was the retention rate last year? What are you budgeting for this year? What's going to make a difference? And it could be the answer is market, but you need specifics for that. So anywhere you see improvements. And then the next thing that asset managers and owners are looking for is, do I think we can do better? All right. So if you're looking at bad debt and you're saying you're budgeting for bad debt to be as bad this year as it was last year, then I go to your PM and say, what can we do? What can we implement? What if I want occupancy? You're budgeting for 93%. And I know based on the rents that I agree with you that we really need to be at 95%. What can we do? Specifically, could be something as small as, okay, we want to go ahead and go to longer lease terms. One of my clients moved to 15-month leases literally in the last 30 days and doing the budget forecast. I mean, that's 9 leases that aren't going to expire in 2026, period. They've already renewed. And let's say 50% of those people are going to renew. It's a little bit higher, but 50%, I mean, that's avoiding 4.5 move outs in 2026. That's tangible.
Hmm.
That's tangible. So what tangible action items do you have? And if you don't have an answer other than, well, we've been getting better renewal rates, you need specifics, you need tangibles, and therein lies your action plan. Well, what if, what's our number one advertising source for move-ins this year? Oh, it's Facebook. Okay, what can we do? Market more on Facebook that could drive more traffic to the property. Maybe you can take from another part of your marketing budget, but something tangible has to numbers getting better or how to improve them.
Yeah, I think, and you probably have a lot of conversations with asset managers as part of your guidance with them, where maybe the previous approach was, to use a quick example you use, like, yeah, we want to reduce our delinquency and our bad debt, and we want to reduce it from 2% to 1.75%, next year, something like that. And they communicate that to their PM. They say, we felt it was too high. Maybe there's some kind of very quick market chatter. Like, it seems like the market's getting a little healthier and there's, maybe because rents have stayed a little lower for a little longer now, we're starting to get a little bit more stabilized and something happens locally from an economic standpoint. And I know we kind of had a lot of evictions this year or something like that. So next year, let's just try to get it to one and 175 or whatever it might be. But it's a lot of feel, it's a lot of anecdotes, it's a lot of general commentary. It's not a lot of specific action oriented. Here's how we can particularly do so. And I think that's a really important note because as you described at the beginning of this episode here, the difference between PMs and asset managers is the asset manager is strategically guiding the PM, and the PM is more so just kind of doing the blocking and the tackling. And if they're a good PM, they probably can share some insight into how they can help you achieve your objectives, but they're still fundamentally executing your vision and your plan as the owner of the building or as the asset manager of the building. So it's really important, as you just described, to actually tangibly define it. So bad debt, right? It's okay. So we got to reduce our skips. So now we have to maybe adjust our screening criteria. Like we previously had a minimum credit score of 580, 600. Now it's going to be 600, 620, or whatever it might be. We're going to raise our minimum income, right? In terms of we're going to go from two
Yeah.
and a half X monthly rent to 3X or something like that. And yeah, we're going to have less, our conversion is going to take a hit because we're going to go from less leads to apps because we have a more stringent screening criteria. But that means we're going to spend a little bit more money on marketing, and a fraction of that savings is going to be reallocated to marketing in terms of our bad debt. And we sit here and we do the math, and we've arrived at some plan that maybe allows us to actually tactically execute that vision. But I think it's a great point because I think fundamentally speaking, a lot of owners don't do that. A lot of PMs probably face some element of frustration with the asset managers, the owners that they're working with, because they're like, yeah, we also want to help you achieve these things, but we got to talk about how we can actually do that. Yeah, and having those conversations before the end of the year is probably really important, or is really important. There was one thing you mentioned here, and I'm almost taking us away from budgets again, but I really want to touch on it. Where you mentioned you had a client who went to 15-month leases. They started to really prioritize occupancy in terms of maintaining higher occupancy. They wanted to reduce the number of leases that were going to turn in 26. A bit of a strategic change. I'm kind of getting sidetracked here, but I thought it was such a great conversational point in our last episode that I really want to touch on it again. The cost of a move out and the cost of a turnover. Like we have in our business made a similar change where we've really incentivized residents both on a first move in and then on a renewal. We're going to offer you the standard 12-month lease, but we're also going to offer longer lease terms, 15, 16, 18 months, depending on the time of the year, to really keep them there longer. And we're going to incentivize price-wise for residents to sign these longer lease terms because we are also prioritizing occupancy in our business and then within our portfolio. And we sat down and we really did the math as a result of our conversation last time. We knew it, we knew turnover was expensive. We knew you lose rent. You got to spend money to turn the unit. You've got leasing fees, etc. But we really sat down and did the math of what that actually looked like, and it was an alarming number. It was bigger than what we knew just based on kind of gut feel and all of that. when we started really adding in the cost of taking over the utilities for those 30 days, for taking in the cost of the leasing fee within our management company, actually amortizing our leasing agent's salary across all the different deals that we were leasing or units we were leasing. And I know a lot of people got some value out of that too. So that was very long-winded, but I do want to give you the floor to really talk about how to think about the cost of turnover, fundamentally speaking. And not a lot's changed, I can't imagine, from April to now. But if you've seen any increases in that cost or any changes of that, just from a market standpoint in the owners you're working with right now.
I certainly have. We're starting to see the increase in flooring. Estimates go up to 40% on vinyl. I haven't seen 40%, but certainly vinyl flooring is coming in higher specifically, and I don't remember the exact numbers of what the price per square yard or whatever it was, but it ended up between we were looking at same floor plan type, same, full replacement, and we were looking at a $312 increase within the same provider.
Yeah, costs are
So
going up. It's getting more
costs are going
expensive.
up.
Materials are more expensive. Yeah.
Yeah. So we're having to have some really tough conversations this past 60 days, 90 days about the quality that we're
Mhm.
going to provide for, and I know everybody wants to provide the highest quality standard make ready that they can because your reputation is attached to it. But listen, nobody wins if you don't have money to pay. The residents don't even win if you don't have money to pay the bills. It's tough, but when you were spending 2,200, now you're spending 2,500 on a vinyl flooring replacement. Hey man, we might have to look at quality that we can afford.
Yeah.
Those are some of the toughest conversations I've had. But this particular client, the cost of turnover, never mind the balance, that was the cost of turnover for this particular client came out to $6,126 on average in 2025. That's vacancy loss, concession, and turn cost. And so 15, yeah, what is it? Nine less leases expiring in 2026 is going to render $25,000 in additional income, and they just got started. So we obviously have to be careful in managing those expirations. Here's a key point. Only renewals who have good payment histories are offered these extended leases. We're not offering them to new move-ins.
Mhm.
Why? We,
You don't know
you
them.
got to earn our trust. Yeah. So, I mean, these are budget conversations, right? We need to think about how are we going to, the ultimate game is how are we going to increase NOI? And there's way more ways to do that than just increasing rents. As a matter of fact, I wouldn't even say rental increases are the most lucrative or the most reliable way to do that. It's just not. The strategy is different if you're planning on putting a deal on the market, maybe you're trying to prove out a concept. But if you don't have a deal going on the market, you should be operating for cash,
Mhm.
for money, for NOI.
Yeah, and I think it's important to understand what you're optimizing for, as you just described, right? If you are somebody who is buying a deal that you're going to sell in 2 years, like that's fundamentally that's going to be the asset strategy, or the strategy with the asset is you're buying it. Maybe it's really distressed. You're going to turn a percentage of these units. You're going to do some exterior work, some common area work. You're going to lease these units at a new market rent and prove the concept for the next guy. Well, yeah, you're going to need to turn some of these units and actually renovate them, and you may need to be a
Mhm.
little bit more proactive about that. And your end game is different than the investor who's planning to hold for 5 to 7 years and is in year three of the hold period, where you've already turned a large percentage of these units. You know you're going to own it for a few more years. You've got the good debt on it. You want to optimize for cash flow and distributions. Well, the easiest way to get there is to minimize your vacancy rate and minimize your turn costs. Like fundamentally speaking, those are such huge levers to manage. And I think it's interesting. I had a lot of folks reach out after our last episode where we spent a good amount of time talking about like the true cost of a turnover. And like, you ran through like the 7 or 8 different line items that actually drive the cost of actually turning a unit. And I think a lot of multifamily investors, even if they've been a multifamily investor for 10 minutes, they just bought a deal 10 minutes ago. They know, oh, when a tenant leaves, they're not paying rent. We got some costs there and a cost to paint it when they leave. But a lot of folks haven't actually sat down and like done the real true math behind it. There's just, some like implicit, if it's vacant for 30 days and the rent's a couple grand, I'm losing out on 2 grand and I spent $1,000 painting it. But the concessions, the paying the leasing agent, the taking over the utilities, there's all of these other components of that drive the cost. And it's like a really critical data point to understand for the types of deals you're buying in your market and, within your management structure, if you're using third party, if you've got it internal, et cetera. Because that then turns people into folks who are like really optimizing for occupancy and cash flow pretty quickly.
It definitely drives your decision making, right? After that, you've got that number in your head. And listen, if you've got a 200 unit property and your cost is 6,100 a unit to turn over, and you've got 50% turnover, that's $610,000. 50% retention might sound really good to you. But until you find out that it costs you 6,100 a turn, and then you're going to be like, well, okay.
Yeah,
So that's a generic way to put it. But yeah, it makes a big difference.
love it. Last question before I get you out of here. Current events, I'm always interested in what folks are kind of focusing on and working on, tools, et cetera. Any tools or resources or anything that you guys are starting to use more in your business or that you're seeing PM companies leverage more frequently in the business right now? I've been finding myself asking this question to a lot of folks as it
Hmm.
relates to every single week I go on LinkedIn and or whatever, I get an email newsletter from somebody who's in multifamily real estate saying this particular AI leasing tool is something that we're adopted in our business and is killer or whatever. So, I found myself trying to stay ahead of the curve, as I'm sure many other folks are. But the answer could be no. We're just banging the traditional drum of the tools we use. But anything that you're seeing that's like a little bit newer as it relates to tools, resources, software, etc.
Man, I'm going to give you my absolute favorite AI tool.
Oh,
There are
yes.
tons. Okay, this is my absolute favorite. Abacus AI. And Abacus AI owes me money for saying this, but I am telling you, so it's probably more than this, but it's 23 different AI tools rolled up into one. And it's got Grok, it's got all the GPTs, but it has a specific tool, which I believe they call it their LLM, that depending on what you ask it to do, it chooses the best tool for the quest that you've put it on, right? And then it has what it calls deep agent, where you can use some of its accelerated tools. And again, it chooses what tools are going to help you best. But I've tested I don't know how many different, it's got Chat GPT-5, it's got Grok, it's got, Claude, it's got all that. It's all rolled into one. But I'm mostly using it as like my thinking partner, right? I just did a chat with it about immigration impact in the US and its impact to the apartment industry. And there's just no way I could have thought through all that with all the numbers, and that's saying something.
That is exactly what I was hoping when I asked that question is that you would you'd give us a nice one that everyone's probably going to go and in Google here, right? I mean, I just did in my other monitor here. I'm going to have to go check it out. It's funny, a good business partner of mine who's a really smart guy, former Amazon engineer, senior engineer. We work together on a lot of deals. He raises capital for what we do. And he's on LinkedIn every day talking about agentic workflows and this tool and automating every aspect of his business. And I'm like, this is probably one of the more important. I don't want to call it a trend because it's not a trend. It's here to stay. It's a
Mm.
fundamental shift in how business is being done and how work's being completed. And then, there's trickle down effects to the real estate industry. But I'm like, if there's something that you feel like you should stay ahead of as somebody in real estate, like you should be dedicating some amount of time into understanding which tools are here to stay, which tools are fundamentally going to change how we work on things. So this is great. Now I'm probably going to go and nerd out on Abacus AI here once we hop off. But that's a great tip. I'm going to link it in the show notes for folks, as I will link our first episode as well. But Stacey, this has been great. I'm sure everyone who's listened to this is going to be getting a ton out of this conversation. Where can folks learn more about what you got going on and reach out to you?
Yeah, so I'm super active on LinkedIn. So find me on there. I spill a lot of the beans on there. As you know, I'm not good at keeping secrets. I share everything. And so
Hmm.
if I've got any knowledge, you'll find it there. I write about my work pretty much daily, or at least 5 days a week. And then you can also find me on the website, which is assetnoi.com. And, you know, feel free to reach out to me there.
Love it. I'll link your LinkedIn profile, I should say, as well in the show notes. And for everyone listening, Stacey's a great connect on LinkedIn. I'm learning new stuff all the time when I'm loading up the feed there. And amidst a lot of the less valuable content, I will say, maybe is the polite way to describe it, that you find on LinkedIn, yours stands out as stuff that's actually tactical and useful. So I appreciate you spilling the beans there as well. But thanks again for taking the time, and can't wait to get this one out.
Oh, thanks for having me, Axel. I had best time yet again. So I appreciate you, love the show, and look forward to talking to you again sometime.
Love it.